Hi, everybody. Welcome to Reunion's webinar series. I'm Andy Moon, CEO of Reunion, the leading marketplace for clean energy tax credits. We work with corporate finance teams to purchase tax credits from solar, wind, battery, and other clean energy projects. A big part of our work is walking buyers and sellers step by step through the transaction process with a close eye for managing risk. Today, we're excited to have Brian Murphy, partner at EY, and Adam Kobos, partner at the law firm Troutman Pepper, joining us. I'd love to kick off by asking each of you to give a short introduction. So maybe touch on you and your company's work in tax credit transfers and summarize what you're seeing in the market. Brian, can we start with you?
Yeah, absolutely, Andy. Thanks for having me. So I am our America's Power and Utility tax leader, and the IRA seems to have consumed all since its passage, including now the development of the tax credit transfer market. So we are spending a fair amount of time working with clients to start to not only put together deals, but to anticipate and think about, is this market the right place for them? How to think about the market and how to start to think about the risks and how to manage those risks on both buy and sell side. So it's an exciting time. It's evolving quickly, and looking forward to our conversation today.
Awesome. Thanks, Brian. And Adam, can you introduce yourself and maybe provide a few thoughts on what you're seeing in the market?
Thanks, Andy, for having me today. I'm Adam Kobos, partner in the tax group at Troutman Pepper. Our energy practice is soup to nuts practice. We represent sponsors, investors, regulated utilities in the market on everything from early stage development right on through financing, various financing transactions, including now post-IRA tax credit transfers. And like Brian said, we're now seeing a lot of activity in the tax credit transfer market, particularly following the issuance of the proposed regulations. So we're working with buyers and sellers. I'm looking forward to our discussion today because it's a very, very new and fluid market. So there's a lot of variety out there, a lot of interesting things to discuss. So thank you again, Andy, for having me today.
Awesome. Yeah, that's a great point, Adam. I think the market really opened for business only on June 14th when the proposed regs came out. But at least from our side, we feel a palpable uptick in buyer interest, I think, as we head into Q4. I think there maybe is a feeling that, if you want to get in on the 2023 tax year credits, now is the time to really be, signing term sheets and getting ready on the transactions. Are you feeling sort of any changes in the last few weeks in terms of level of interest or engagement on the tax credit transfers?
I think the usual thing happened, which is after Labor Day, everybody came back and with renewed sense of purpose to get moving. And yeah, Andy, I think you're right. The desire to get tax credit transfer deals done this year has fueled a recent surge. And I do think this is new to everybody. And so everybody really wants to get their first deal done so they can understand how it works, work out the kinks and those sorts of things. So I think there's a lot of pressure also, even if it's a smaller deal, to get one across the finish line so that everybody has done at least one. And so we're seeing a big push now.
I definitely agree that what's been surprising for us is that we think that buyers are broadly aware of the opportunity. I think maybe 6 months ago, people weren't sure what a transferable credit was, but I've been surprised by the level of awareness. And I do think that a lot of buyers are really clicking one level deeper to understand, what are the transaction mechanics, what are the risks, and how can we get a deal done in 2023? Brian, any observations from your end?
Yeah, absolutely, Andy. And as we kind of think about these bilateral transactions that are already coming together with increasing level of frequency in the last few weeks, what's interesting is kind of the evolution of the buy side of the market, that awareness and that interest level as it ratchets up, how we expect that to begin to influence the terms, the conditions, the pricing. So if we were to talk about what we're seeing so far in terms of pricing, there's a distribution and it follows a little bit of a bell curve. And I'd love to hear, Andy, Adam, if you see things much differently. But if I were to look at that bell curve, it feels like the tails are in the 90, 91 cent area, the other tails in the 95, 96. But deals are really coming together in the middle of that bell curve, 93 cents, 94 cents. A lot of focus on the terms and conditions. There's a lot of uncertainty yet. The IRS has not stood up this registration portal yet. So there's some critical gating things still to come. But as you watch the buy side really become cognizant of this market and start to understand the impact that it can have on their cash, on their tax payments, and the value that's there for them to unlock, the expectation is that the buy side will continue to grow and it will start to have an influence on those terms, those conditions, those prices.
Yeah. And Adam, in an earlier discussion, we talked a bit about pricing and how maybe, there's a lot of talk of the discount and the headline number of 92, 93 cents on the dollar. But maybe that's a bit simplistic in terms of how to think about pricing. Any thoughts you want to add in terms of, payment terms or other ways to think about the discount?
Yeah, I think there are a couple things to talk about here. First of all, I would agree with Brian's range of pricing. That seems to be where the prices are clustering now. And what is interesting is in the deals that we're seeing, the prices are being agreed to before the payment terms. And the payment terms here are really, really important. There's the headline discount number, which is significant, but there's also the time value of money component. Because at the end of the day, this is a way of managing tax payments from the buyer's perspective. So the proximity of the outflow, the purchase of the credit to the next estimated tax payment, that's a big deal. And what we're seeing now, I think, is a desire for everybody to get their first deals done, and so they're not as sensitive maybe to the time value factors. But I do think as time goes on and people get more comfortable with just the baseline transactions, there's going to be a lot more focus on those timing questions and maybe a little bit more sophistication in the documents to capture those nuances.
Yeah, Adam, I think you hit it right on the head. There is kind of a very critical focus on just that price, but the time value of money is so important here, and that the regulations brought the clarity that if you have acquired these credits or the intent to acquire these credits, and we can drill into what that looks like in the market, buyer gets to factor that in to their estimated payment. So Adam, I totally agree that time value of money impact that has in terms of potential value to buyer is tremendous. And to talk about price without talking about those timings and those timing issues in those terms, it's kind of disconnected. It really doesn't tell you the whole value story. And I start to see the market really becoming cognizant of that, Andy, and I would expect that become a very critical discussion point. How soon in the life cycle of a project can you actually pencil to acquire that credit, deem that to be an intent to acquire the credit, count it in your estimated payment, and yet have a substantial deferral in when you really have to write that check?
Yeah, those are great points. And I think this will be a really big issue as we go into 2024. I think it does make sense that buyers are fixated on discounts in 2023 because most projects are basically constructed already. They're already placed in service, or they will be placed in service, in a matter of probably weeks at this point. And because of that, most of the estimated tax payment dates have passed for 2023. I think there's one left. And so for that reason, in 2023 transactions, probably the discount is more relevant. And I think the ranges that you mentioned, Brian, do make sense. I'd say perhaps the one addendum I would say is we've seen a fairly wide range. So I definitely think PTCs, spot PTCs that are lower risk, those are trading in the mid 90s. ITCs from well-capitalized sponsors and experienced projects with some scale, we're seeing those trade in the low 90s. And, there are less projects in 2023 that are sort of very small or new technologies or things that would merit, a trade in the 80s. Although we do think that in 2024, those projects will emerge. The IRS was very clear that if a transferee purchases or intends to purchase a tax credit, they can use that to offset their quarterly estimated tax payments. What are you seeing in terms of buyers being comfortable with making those offsets?
Right. So there's a little bit of a continuum there, Andy, and I would say if you keep reading in the proposed reg, they give you that opportunity to say, if you have the intent to acquire the credit, as a transferee. You can factor it into your estimated payments. They go on to say, if you actually don't have that credit when the day comes to file your taxes, that didn't work out, that shortfall is on the transferee. And so there is, I think, a variation across, all these buyers. And a lot of it will come to, part of it might be, do buyers feel they need that registration number? Do they need the IRS portal stood up and transacting? And I think part of that is also associated with real or perceived quality of the seller. Is the project already built? Is it on? Is it delivering? Does the seller have a track record in this space? Do they have the history of placing in service, being audited, sustaining their credit? So there's a lot of factors I think will go into a buyer's assessment of what's my level of comfort that this transaction is going to ultimately happen. Maybe delayed a little bit just for timing, maybe the portal's not stood up, but what's the level of comfort that I know I have a deal that is going to produce a credit for me to use? And so I see buyers all over the continuum, some that are maybe focusing on that IRS portal standing up, and not necessarily as just a rigid toll gate of the registration number, but taking comfort that that process that the IRS is going to put the seller through has some value and merit to say, that project is real. That project is going to produce a credit that I have on my bilateral contract, an agreement to buy. And I think as we get into 24, this time value, to your point, is going to become a lot more impactful and a lot more of a focus of discussions because of its ability to impact that estimated payment deferral.
Right. And looking into the crystal ball, I know maybe both of you have had some dialogue with the IRS in terms of getting feedback on the portal. Any predictions as to when that pre-registration portal might get stood up?
I'll go first, Adam, and I'm the somewhat always optimistic glass half full person. I had a unique opportunity, and many others have had it as well, though, to be in a small practitioner group to meet with the IRS and get a little bit of a check-in on where they are in the life cycle of developing their process and their platform, their portal. This was several weeks ago, maybe 3 weeks ago. I would say I was very impressed with the thoroughness of the process, how they're approaching the development of the platform. The web pages they showed us, very user-friendly and seemed to really be tightly aligned with the guidance that we've received so far. I will also say this is not just putting out guidance. It is more challenging. The portal is a complex piece of technology, and so where it felt like they would not commit to a date by any means, but from my view of where they were in the development process, they still had a little ways to go, and to see that stood up before, let's say, December 15th, kind of that next estimated payment date, not impossible, but would be impressive. I would probably say to get it by the end of November, early December, 50-50 at best. There's a lot of work that has to go into a tool like that.
Awesome. That's great. That's great insight. Adam, any thoughts there?
I've got no better information than Brian does on this, but I think there's institutional pressure and then external pressure to get the portal finalized as soon as possible. The IRS had tipped its hand a few months ago saying it wanted to be done by the end of the year. And to Brian's point, that last estimated tax payment date would be a reason for them to try to get it done maybe a few weeks before then, late November. So that's the target. But to Brian's point, it's a big technology project, and we've seen prominent displays through the years of technology rollouts that haven't gone well for the federal government. So I'm sure they'll want to get this right. So fingers crossed it'll be there by the end of the year, but we'll have to see.
Yep. So we recently wrote a blog post detailing some of the time value of money scenarios under which a buyer can purchase a credit. And let me talk about the most optimistic scenario and get your thoughts on it. So the best case is for 2024, if a buyer commits to buying credits at the beginning of the year for a project where they don't have to pay until later in the year, right? So let's say they commit in January and the project is placed in service later in the year, and the buyer can then therefore, pay for the credits, call it in Q3 or Q4. Then essentially they can start offsetting their quarterly taxes even before any cash has gone out the door, right? And as a business owner, you're almost getting working capital efficiency from the government, right? You're offsetting your taxes, and you don't pay any cash until late in the year. Are you seeing buyers excited or comfortable with that? Because it's certainly, that's certainly what's been outlined in the regulations, but it is very attractive from a cash management standpoint.
Adam, I'll go first. And I would say from a seller side, Andy, there's definitely an expectation from sellers that, let's say, have been in this business for a while and view themselves as high quality sellers. You can count on our pipeline, our construction schedule, our delivery, and the substance of our credit. They are expecting that they'll be able to get the buyer comfortable that they can execute that contract in January, even though that asset may not come into service till November or December, and with a level of confidence start to layer that into their estimated tax payment and get that, we'll call it, full year benefit of that time value. That looks to be real in the market. Those same high quality sellers would, I think, have an expectation that there may be other sellers in the market that aren't able to generate quite the same level of comfort for the buyer, and that difference should start to generate some discount spread, because that seller who says, I'm high quality, you're going to get this time value, is probably also going to expect a smaller discount on the credit, because they're going to want buyers to kind of look at this holistically. What's the entire value impact for you? It's the discount and the time value.
That's a great point. Just another factor that inputs what the ultimate headline discount rate might be on the credit.
Right.
And maybe, Adam, can you talk a little bit about sort of the risk that, what happens if a buyer purchases, or a buyer, signs a tax credit transfer agreement, they expect the project to go into service late in the year, and then it ultimately doesn't happen. Kind of what happens in that scenario? Is the buyer just stuck trying to find replacement credits, or kind of how does a buyer deal with that situation?
Yeah, we're seeing different approaches in the market in terms of how to handle that risk. In some transactions, there's really nothing done to cover off that risk. It could be that the parties decide to just walk away. The transaction's never completed. But in the tax equity markets, some financing parties will charge a breakage fee, and I think we expect to see that creep its way into some of the transactions, the tax credit transfer transactions as well. So that if the seller fails to deliver a credit on time, they may owe some sort of fee to the buyer to compensate the buyer for reserving that tax capacity and then not delivering on the credits. So I think there are a couple different ways that you could see that go. That could also be just factored into the upfront pricing. Maybe it's just that risk is priced in with a higher discount at the beginning, and then sort of absorbed by the buyer on a global basis. So I think there are a few different ways for that to work its way through. And we're not seeing any sort of one size fits all approach. It's a bit all over the place right now.
I think in general, our viewers love to go into the details, the nitty gritty details. And so there is one question about sort of, there's projects that are scheduled to be placed in service in December. And we all know that developers are optimistic about construction timelines, and sometimes December projects end up getting placed into service on December 25th, or it might slip to January. Adam, how do buyers deal with that uncertainty around when exactly the place in service date is on a project?
That really is a tough issue. It's a tough issue even in tax equity financing transactions, because that year, the year when the project's placed in service, is the year when you get the credit. So there are return metrics and other things that makes a difference. But in the tax credit transfer market, it's an existential risk. So obviously, buyers are going to be looking to fill or deal with tax capacity in various years. And so it may be that they need it in one year and can't use it in the next, or don't want it as much in the next. Maybe they've already reserved capacity. So that's one issue. But then the other issue is the placed in service test is, unfortunately, it's a 5-factor test. It's a gray area. If you've got none of the factors, you're not in service. And if all of the factors are satisfied, you're in service. But if you have 3 or 4 of the factors, you're in this sort of gray area. So when that happens right around the end of the year, you could have serious questions as to whether it's in service in 2023 or in service in 2024. And the problem is, there doesn't appear to be any sort of way to account for that in going through the tax credit transfer registration process. So you got to pick the year and get it right. And if you get it wrong, it's not really clear that that registration would carry over to the next year. So in addition to all of this capacity stuff, you have a qualification issue. If you don't really know with certainty what year the project's placed in service, there's a chance of guessing wrong.
Yeah, just one other thought on that, Andy, was, sometimes you do know that, to your point, maybe you have 0 of the factors, right, Adam, and it slides into 24. And we haven't seen a lot of it yet, but I do expect in terms and conditions to some degree that buyer will ultimately start looking for, if I intended to acquire 23 credit or 24 credit, and you're unable to deliver that particular credit, and I have to go to the market, I may end up with a different price, some kind of make whole provision or some kind of cure provision. But to your point, it may not be crystal clear when you get to December, January, February, whether or not you even have a project that was in service in time.
And what we may see, I think, is in the tax equity market, that for solar transactions, you have a 2-step funding. So if the ITC is at issue, the investor will often invest, say, at mechanical completion of the project, with a further investment at substantial completion. And those bookends are there to deal with the placed in service concerns. So the first funding is on a date when the project hasn't been in service, and the last funding is on a date when you're certain the project has been placed in service. And it may be that bookend approach creeps into the tax credit transfer market, where you see, if we've got a 2023 credit, we're going to want all of those factors to be satisfied before the end of the year. And if we've got a 2024 credit, we're going to want to make sure that none of those factors were satisfied at the end of 2023.
That's a great point, Adam. Now, one related question is, in the tax equity transactions, tax credit insurers are generally willing to take a view on place in service date as part of the qualification insurance. Do you anticipate that they will also take a view on place in service dates for the transferable deals?
I think they should. I think they should be able to get there. That's the sort of insurable risk that they ought to be able to do. Sometimes the placed in service is carved. We've seen policies where initially the placed in service date is kind of carved out as an exclusion. But we've been able to, in those policies, get them to keep it as a conditional exclusion until the project actually is placed in service. I think their issue is they don't want to, they're not going to insure when the project's only mechanically complete that it will be placed in service in the future. But I think they're comfortable, with the proper diligence, they're comfortable insuring over that placed in service risk. So yeah, I think the insurance market should get there.
Yeah, Adam, I would agree. And you just alluded to this, that this is probably more of an ITC issue than a PTC issue. And Andy, I know we may talk a little bit later around how the market might view different credits and different components of that credit differently, but that's a great case in point that, to the extent you're going to market with ITC, it becomes very binary when you're in that December window.
Absolutely. So on that topic, maybe we flip to buyer preferences in terms of technologies or various credit adders. I know, Brian, you had some thoughts there. Maybe we start with you in terms of what you're seeing from buyers in terms of their preference on technology or credit adders.
Yeah, I do start to see a preference for established technologies, wind, solar, we also start to see some bias or preference for, let's say, the production tax credit. And I think that's correlated to both the real and perceived simplicity of the credit, the amount of diligence it takes to get comfortable that that's a qualified asset that may already be in service and established producing the credit, and the math that goes with how much production tax credit did you generate is relatively straightforward compared to the ITC. The benefit of the ITC, clearly that it's the value of that credit comes in all at once right up front, but there are other risk factors coming with that investment tax credit, particularly from the buyer lens. We just touched on some of them with Adam. Was that really in service in time? Do I know it's a 23 or a 24 credit? But there's also the question around the basis that is the energy property that's qualifying for the credit. And in the tax equity market, Adam knows this as well as anyone else, so do you, Andy. In the tax equity world, for years, these investment tax credit deals have been put together in a manner where there is fundamentally a transaction that captures the step up between the cost and that fair value to really kind of optimize that investment tax credit. There'll be some question if this isn't in tax equity and the developer owner says, I just want to sell my ITC, are they giving up something between their cost and that fair value? How do they rethink their construction cycle, their structuring? Are there paths to get to it? But buyers are also going to say, well, there's more complexity to that investment tax credit. There's more things I have to stand. There's more risk. There's the clawback, right? There's the potential for recapture in the investment tax credit. So I think if those factors are going to start to creep into not just terms and conditions, but into price. And Andy, I think you alluded to, we haven't seen a lot around other new or nascent or emerging technologies yet, but as they come on the scene in the future, they're probably going to have some risk-adjusted pricing associated with them. And we probably shouldn't completely leave out the fact that there will be nuclear production tax credits in the market as well. And so I do think buyers are going to look at these technologies differently. And I've also had indications from buyers that want to understand the composition of the credit, the base credit and the bonus credit, but they want to know, is there an energy community adder in there? Is there a domestic content adder in there? And without a doubt, I'm seeing a bias for simplicity for the base and the bonus credit. The adder that gets the most attention is probably domestic content. And I am seeing buyers, large credit buyers, out of the gate have a little bit of a preference for the simplicity and not wanting to look at deals out of the gate with a domestic content adder. But the energy community, I actually think, is probably an easier component to get comfortable with as an adder, maybe even easier than understanding for projects that were subject to the prevailing wage and apprenticeship. Did they check all the right boxes and accumulate enough to say, yes, we absolutely have the bonus credit? So, Adam, Andy, your views are obviously just as informed, if not more current than mine. Curious what you're seeing or thinking.
On our platform, we have $3 billion of credits looking to be sold. We see very few with domestic content adders. And I think part of that is that given the lack of clarity in the guidance, developers are also hesitant to add that into the projects because the guidance was clear that you can't split the adder from the base credit. And so if there is a disallowance of credits for any reason, that will impact developers because they're on the hook for the indemnity.
Yeah, I would say with respect to domestic content, that is the hardest one to work through. We're working with a couple sponsors now who are committed to making it work, but it is very, very complicated. And so I think there are some strategies both on the solar side and on the wind side to get there, but the analysis that you have to go through is tough. And I do think when the deals start coming to market, it's going to be novel. So getting financing parties, tax credit buyers comfortable is going to be, well, I'm certain of it. It's going to be an adventure. But I think we will see them. I think we will see them. But as both of you have alluded to before, some of the other adders I think are almost humdrum by this point. The fossil fuel adder, the coal closure adder, the adders did a great job in making those just about as straightforward as they could be. So I think the market's kind of gotten comfortable with those, and we're seeing those in our deals now. The brownfield exclusion's a little trickier, but we're confident that we'll see those transactions financed as well, tax credits purchased from those. And I think Brian alluded to this as well. On the labor requirements, the regs are still kind of new. And so I do think people are trying to figure out exactly what everybody wants to see from a buy side in terms of the support for compliance with the labor requirements. Will it be just reps, or will there be some sort of third-party report, or what is that going to look like? And I don't think we quite know yet what that's going to look like. But again, I do think that's something fairly quickly that people are going to get comfortable with and transact on.
Yeah, we've also been seeing a lot of energy community, and I think for prevailing wage, I mean, luckily in 2023 tax year projects, many projects are exempt because they started construction before January 29th. But absolutely in 2024, it's going to be a very big issue to ensure that that all the documentation is in place. And Brian, I think you had some great points about sort of there is a provision in the regs that if labor is underpaid during the construction process or during major repairs afterwards, that could trigger a reduction in credit. However, there is a cure period that's allowed where you can, true up the payments and not be subject to a reduction in the credit level. However, you do have to know how to locate the people and provide the payment. So, Brian, any thoughts on sort of what kind of documentation would be useful to collect at the construction stage to ensure that PWA is met?
Yeah, when we talk to our clients that have projects that have started after, to your point, January 29 are going to have to meet this standard. The simplest message is collection of the data contemporaneously to give you the ability to identify those short pays and have a cure. But even if you have something miscategorized, at least to the extent you've contemporaneously collected the data, even a subsequent audit, you have that opportunity, to your point, Andy, to take advantage of those cure provisions. I would caution developers and others to not take too much comfort in a strategy of, hey, EPC or contractor, you accumulate the data, and if and when I need it, I'll call you and you provide the data. I also think that introduces a little bit of risk around the requirement of being able to accumulate the data, provide the data to the buyer. So contemporaneous, I don't know if it means weekly or biweekly or monthly, but it is a cadence with your counterparties as a developer through the construction and placed in service cycle to collect it, analyze it, have access to it, because those cure provisions are there. You just need to make sure you put yourself in a position to be able to avail yourself. The worst thing will be subsequent to be audited and say, okay, you had contractor A, B, and C. We need the detail at an employee level of boots and gloves on the ground. And you say, well, we just have a collective number and we can't unpack it. Let's go to the contractor, and the contractor's not there, or the contractor doesn't have the records. Then to your point, Andy, cure provisions may not be your lifeline if you don't have the ability to apply them.
That's right. And in terms of certifying the payroll and really ensuring that you're compliant with the Department of Labor's wage determination, we've heard of some developers that will do it manually, and they just, they'll track it in Excel and sign the forms. Others will use software providers. Others use consultants. There's plenty of Davis-Bacon service providers that are available. What are you seeing any preferences emerge in terms of how buyers and sellers are dealing with ensuring they have the correct wage determination?
So I'll start, Adam. I will say, particularly in this industry, when you get to, I'll say, utility scale, wind and solar, it's not an inconsequential number of parties that are putting boots and gloves on a work site. And so EY, and we're not the only ones in the market, but we developed a tool and a process to help clients go through this. And it works directly with the sam.gov website to continue, to repeatedly go back and make sure we have the right wages for when new employees come on, and mapping those jobs to the wages and trying to find those gaps and deal with them on a real-time basis. It's not that it's not possible to do manually, but you really want to make sure you don't underestimate the volume of data. It's simple in concept and execution, but it's really a heavy data intensive exercise to accomplish, and to accomplish in a way that you have your records organized for your own purposes, for IRS, for buyer. Because I ultimately look at this as somewhat of a due diligence process, and the seller has a level of obligation to have, I'll call it a sell side due diligence package available to that buyer to say, here's why you should take comfort and confidence in the fact that this is a credit that you can acquire and take on your return.
I would agree with that. I mean, I think we're seeing all sorts of different approaches at this point. Some doing it internally, in an informal way through Excel or otherwise. Some hiring third-party consultants for maybe a deal-specific review of what's been done. And then others really trying to figure out systems internally. Some of our larger clients, utility clients, or other large IPPs, figuring out how they're going to bring this function inside, and maybe with some software solutions or outside consulting to get those systems in place. What is clear is that the regulations are not rocket science. When you read through them, they make sense. Step by step, it works. And when you start thinking about how it's going to work in practice, your head explodes, right? So I was working on an EPC contract this morning, trying to get this on paper, and it's flow charts and if-then statements and decision trees. It really does get complicated. So it does seem like the perfect thing for, it's an in-house function or third-party service provider, somebody who's coming with expertise or develops that expertise to handle it. And the industry will get there, but in the meantime, this interim period is going to be painful as we all try to figure out kind of the ins and outs.
Yep. And going back to buyer preferences, Adam, you mentioned a lot of buyers looking to get their first deal done in 2023. So given that PTCs can be simpler and don't have recapture risk, are you seeing a preference for PTCs, or kind of evenly split between PTC and ITC?
Yeah, our deal mix has been, maybe in volume, overall credits, maybe it tilted a little bit more to PTCs, but we've seen a lot of ITC deals. And some of that just has to do with the fact that tax credit transfers are the only way to monetize credits for some of these smaller deals. Mm-hmm. So, a year and a half ago, a standalone battery storage didn't qualify for anything. A renewable natural gas, waste to energy facility didn't qualify for any credits. So the tax credit transfer, it's really the only game in town for some of these technologies that don't fit neatly into a tax equity structure, or just got placed in service before there was time to get one in place. So there is this like a glut of novel, sometimes smaller deals that are ITC weighted, but to points that both of you have made earlier, PTCs are so much easier to deal with. The qualification issues for the ITC are really, really complicated, particularly when you've got projects owned in pass-through form. Some of the disqualifying rules are really, really difficult to deal with. And then this concept of recapture, right? So something after the project has been in service could invalidate the credit that you took a few years ago. I mean, that's just a tough issue to deal with. So PTCs are very, very simple. And so I think very, very attractive from a buyer perspective, no doubt.
Yeah, and I think we're very excited about the possibility of providing financing that didn't exist before on some of these smaller projects. I think that's always been the promise of transferability, that
yes,
not just the huge projects that get funded. And I think for sure in 2023, I think there are buyers that prefer established counterparties, very large projects to do a very discrete bilateral transaction. But I do think that the creativity for, mitigating risk on the smaller portfolio is going to be very exciting.
Yeah, Andy, to that point, I think that is really the promise of tax credit transferability. The tax equity market is incredibly selective, and at this point, oversubscribed. And the large tax equity providers get to pick their sponsors, and they're going to pick the sponsors that they've done work with. They're going to pick the sponsors who are the most established, the most reliable, and those sponsors are delivering huge amounts of projects. So the promise of tax credit transfers is, allowing people to monetize the tax benefits from some of these projects that are either developed by smaller sponsors who don't have access to tax equity, or it might be projects that don't fit neatly into the tax equity framework. Projects like a standalone battery project that the owner would like to operate merchant. Tax equity providers aren't going to be comfortable with merchant projects, but if you can make more money that way and then sell your credit, that looks very attractive. And so I think there are classes of projects that really fit neatly into the tax credit transfer market, which is, Andy, to your point, I think one of the exciting things about this market. It's gonna grow the tax credit monetization pool significantly.
Yeah, absolutely. So we got a lot of great questions from readers about the details of what's market in terms of transactions. So maybe we can go through these in a bit of a lightning format. So there's a lot of questions. So Brian, what are buyers expecting on indemnity coverage?
Without a doubt, buyers coming to market want to view this transaction as almost debt, time value of money, and mitigating risk is the name of the game. So to some of the points Adam just made, those are the reasons I think I'm seeing and will continue to see a lean toward PTC. It's what's the simplest digestible transaction where an indemnity is something that can be drafted that will be really effective to sit right on top of the PTC. And the timeline, the realization for the PTC, I think brings a lot of comfort. The ITC with the recapture has a long tail. So I think we're going to see indemnities that are crafted to really give a buyer the comfort that this looks and feels like a debt transaction. They just want to make whatever that spread is on the time value and the discount and almost view this as a treasury function and not an investment in renewable energy or the project.
Yep.
I would agree. If you spend 95 cents on a tax credit, expecting to get $1 and you lose the 95 cents, it's a nightmare. So buyers are looking for airtight indemnities and then credit support. So it's a creditworthy guarantor, tax insurance, letter of credit, something to backstop the indemnity.
And what are buyers looking for in terms of seller creditworthiness?
That'll vary. That'll vary. So the credit determination, and I'm a tax person, so I'm not there in terms of evaluating credit. But look, if they're looking at a credit from a major utility, there's going to be a creditworthy parent in the structure that's going to provide the buyer with the comfort that it needs. But if it's a small sponsor or if it's a private equity backed sponsor, there may not be a guarantor for the buyer to go after, at least as a first resort. So tax insurance is really, that's going to be a tool in many of these transactions that will need to fill the gap.
Yep.
Yeah. When we talk about that quality of seller, I think was the term we used earlier, and how that correlates to price and risk management. If I focus on the regulated utilities, let's say just as a sell side part of the market, that regulated utility in most instances is going to have an expectation that they have a certainty of revenues and that there's pros and cons to that regulatory overlay. I think some of the pros would be, to Adam's point, that the regulated utility would say, my balance sheet is incredibly strong, my outlook is strong, and my indemnity is solid as a result of my balance sheet and the nature of my regulated business. I would say as a seller, a regulated utility probably double-sided, that as they go into the market and they look to sell credits, that they have that additional layer that may create some comfort that the credit is a good credit with a good balance sheet behind it, but it also injects for the utility the situation where ultimately the regulator may look back and say, well, when you sold credits, what price did you get? How did that compare to the market? So I think regulated utilities may look through that lens, and in order to ultimately feel good about the price and that the price will hold up to scrutiny on the sale, not just by their shareholders, but by their regulators, uh, I expect they may take advantage of a variety of contracts and platforms. And Andy, you and I, as we talked about everything Reunion's doing and what EY is doing, EY will ultimately run a different type of credit sale market and auction process. And one of our thoughts would be, well, that auction, even if it's only periodic by a utility, kind of gives them checkpoints that they are really selling at a market price. And so I think there's a lot of pros and cons, I think, for the utility and for a buyer interacting with a utility.
Right. And Brian, we've seen utilities on both sides of the ledger. We've seen utilities looking to sell credits out of projects they own. We've also seen utilities looking to purchase tax credits as well. Where do you think the market shakes out on average? Will utilities be net buyers or sellers of credits?
I expect net sellers for a while. I think we're still in that kind of NOL period. The sale of these credits are going to be very attractive to the utility. Most utilities, Adam, you know better than anyone else, really haven't found their way into the tax equity market. And so a lot of this depreciation and credits have accumulated on their balance sheet. But I do see in short order each year, 24, 25, 26, more and more utilities kind of running off that balance sheet and starting to see themselves flipping into a net buyer position. But with, I guess the observation is every utility should be a buyer or a seller. To say I'm kind of right on the fence and I have just enough credits but not too many is not probable.
For sure. For sure. One item that Brian, you touched on earlier is basis step ups in transfer deals. And we've heard a lot of talk and a lot of interest in developers finding ways to step up the basis. We have not seen that many in practice, but I would love to hear what you both are seeing.
Now, Andy, I would say maybe two things. One is contemplation in the market about, is there room for both tax equity and credit transfer in the same structure? Continue to do tax equity,
Mhm.
but for the traditional banks that have been that tax equity investor, does this transferability provision potentially give them a little more capacity, at
Yes.
least in the sense that if they at any point see themselves potentially long on credits, they now have an ability to maybe direct that partnership to sell the credits instead of allocating them out. So there may be an opportunity for some hybrid, but I also see a strong migration to PTC away from ITC. And some of that, even in the solar space, I think is, and COVID kind of put a bump in this statement, but for some supply chain constraints around COVID, there's been a general improvement in the technology. So as prices come down to build a particular solar facility and its output and its efficiency start to go up, the math just continuously starts to creep toward away from ITC and toward PTC. And so I see an evaluation of portfolios. Hey, which projects economically are ready to make that flip into the PTC? And are those the projects that may move first to the line in terms of credits that are going to be brought to the market for sale?
That's a fascinating insight. I'll comment on the tax equity hybrid model. We're strong believers that many tax equity partnerships will look to transfer credits, just given the fundamental shortage of tax equity. It's much harder to get tax equity done than it was even 6 months ago. And we've talked to a number of banks that are fully committed for all of 2024. And so we strongly believe that, partnerships will look to sell, to transfer credits to make room for more investments.
I would agree with that. I think it's now common, maybe universal in tax credit or tax equity deals that we're working on to provide that functionality for the partners to sell down their tax credits. And so I think for the tax equity, the big tax equity investor players, that's just part of what they're going to do, or they're going to want that flexibility. And that hybrid structure is attractive because they're monetizing depreciation as well, and that's one of the things that can get lost in a pure tax credit transfer deal. But in addition to that hybrid tax equity structure, we're seeing a lot of interest among sponsors to figure out ways to step up the basis. So even if they're not going to go down the road of a traditional tax equity structure, there are call them cash equity investors out there offering products by which they'd sort of invest alongside the sponsor in a partnership. And so the sponsor would develop a project, its development affiliate would sell to this joint venture between another affiliate of the sponsor and this outside investor. And if structured in the right way, you can effect a basis step up and kind of move forward, have that new partnership sell the tax credit deal. So those deals get a little bit complicated. And at the end of it, people are asking the question, well, why didn't we just do tax equity? But if you get over that, I think we're going to see those structures as well.
Yeah. And Adam, that's a bit of what I was getting at. We've also heard of those structures, and we do know a couple funds that are interested in taking minority stakes in these types of projects. I guess from a legal standpoint, there's a couple questions there. One is, if you sell, what percentage of the stake do you need to sell to a third party? Is 20% sufficient? And I think second is, if the minority investor is taking a preferred equity return, will that be respected by the IRS as a true equity investment, or does that look a little too much like debt?
Those are exactly the questions. Without commenting specifically on numbers, those are exactly the questions. And in structuring these transactions, we've taken the view that you can analyze them by principles that operate in the context of tax equity. So that debt versus equity question that runs right through tax equity investments. And what is the size of the investment? How significant a component does it have to be? That runs through the tax equity financing structure as well. So some of those partnership questions that we'll work through on the investor side as we're structuring deals, they're going to migrate over to those cash equity deals as well. But not to tip my hand too much, the partnership flip revenue procedures provide some thoughts as to what maybe that residual interest ought to be and what some of the upfront economics or parameters you've got to live by. And so those might help inform some of the structuring questions. But we're seeing a big variety of structures in the market trying to address this cash equity question, and Andy, structured with the concerns you have in mind.
Absolutely. Let me end on one very fun and perhaps controversial question, which is, we're seeing Bank of America and JP Morgan capping step-ups at 15 to 20%. I think some insurers are still willing to insure step-ups a bit higher than this, but looking at the crystal ball, where do you think step-ups shake out? In 2 years, will there be step-ups, in the 20, 30+% range?
That's a very good question. So you are right that there are segments of the market that put caps on it. In the deals that we see a very wide range of step-ups, ranging anywhere from that 15 to 20% level to 40% and north of 40%. And tax practitioners, I think, have different views about this. I am, from a methodology perspective, biased to the income approach. I'm not a valuation expert, but if the appraisers are thoughtful and conclude as to a higher step up, there are some projects that are just worth more than other projects. So from a tax lawyer perspective, I'm okay going above that. From a risk management perspective, investors and buyers then have to decide how high they want to go, and do they want to be do they want to fall outside of the herd? And that's a more complicated, nuanced question, and you see buyers and investors going different ways there. Brian, I can't wait to hear what you have to say on this.
I would totally agree with everything Adam said. I would say as a as a tax practitioner, that 15 to 20% that we've lived with now for, oh my goodness, it's come out of the 1603 grant days, out of a Q&A. There's no real substantive technical merit to that. Adam's spot on that there should be a perfect correlation to the risk and complexity of development of a project to what should be earned by the developer who took that risk. And to say it's 15 to 20 is somewhat arbitrary. So I think from a tax technical perspective, being able to have projects with the right fact patterns that go well north make all the sense in the world. I do think from an insurance and a buyer perspective in the market, there is, and tax equity has, I think, contributed to this comfort that being within that 15 to 20 somehow gives you a little security moving to the middle of the pack and not being on the edges. And so I think there's going to be continued preference for more historically, comfortable ranges in the development fee that are in that window or south. That bothers me from a purist perspective, because I think there's projects that are probably claiming that maybe not are warrant 15 or 20 but feel comfortable in that window, and there's projects that probably took tremendous risk and time to develop that warrant more than that are constraining themselves to be acceptable to counterparties in the market.
Awesome. Well, Brian and Adam, this has been an awesome conversation. Thank you so much for joining today. As everybody can hear, there's a lot of activity in the market. Q4 is going to be very, very exciting. Hope to work with you both on some transactions, and thanks again for appearing on the show today.
Looking forward to it. Thanks for having us, Andy.
Thank you, Andy.
Bye.